Hello viewers, welcome to this new video. So this video is on a company which most of us, we use in our daily life to eat pizzas, which is nothing but Jubilant Foodworks. So yesterday, Jubilant Foodworks share was down by almost 12%. But if you look at Jubilant Foodwork price, the stock has not done well in last 2-3 months, and the price is down from almost 4,500 rupees to 2,400, 2,500 rupees. So basically the stock has lost all its 1 year of gain. So the question is, what is eating Jubilant Foodwork and why Jubilant Foodwork share is falling? And the company has been a huge wealth generator. So what has gone wrong? And 2 months back, we had done a webinar on QSR food industry, quick service restaurants. You can access this webinar. It's there on our LMS portal. The link is there. And we also studied Jubilant Foodwork. And I think that time when we studied, the price was somewhere around 3,200, again, fallen from 4,500. And our view was the prices were still not in our attractive band. But let us try to understand first, what is the company all about, and what is the kind of valuation we should give, and why the price is falling. So when we try to analyze such a drastic price fall in a stock from 4,500 2,500, the first doubt which comes in mind is whether these kind of business segments, they can create wealth over a longer period of time. And for that, I will take this tweet from Charlie Bilello. He said software is eating the world and the world is eating pizza. And he used the Google, stock chart and compared with Domino's Pizza. So if Jubilant Foodworks, they sell pizzas, and basically they sell pizzas as a franchisee for the brand name called Domino's. And if you look at the Domino's performance, Domino's and Google, both of them, they got listed in US market somewhere in 2004. And we all talk a lot about Google and the kind of wealth it has created, but you will hardly see anybody talking about Domino's Pizza. But when you see the return performance of Google versus Domino's, Domino's is given a head-on-head, competition to Google, and Domino's has also created almost equal amount of wealth or very similar kind of wealth which Google has created. And that is why the statement, the software is eating the world and the world is eating pizza. So it's like this industry. Of course, this industry can create tremendous amount of wealth, and not anybody else, but the Jubilant's brand owner itself, Domino's, they have created humongous wealth for the shareholders. So with that context, let us try to understand a little bit about Jubilant Foodwork. And to understand Jubilant Foodwork, we need to go back to the brand owner, which is Domino's, and let us try to understand how Domino's has done and how Domino's has created this kind of wealth. And if this basically the slide is from Domino's investor presentation. And if you see Domino's, basically they have 16.1 billion of retail sales. They have globally 17% market share in the global pizza market. And if you see their global retail sales, the parent Domino's itself has grown at 10% CAGR, given they are present in US and a lot of developed nation. And in US also they follow, they call it a one store, two business model, where on one side they have a carry out and one side they have a delivery, and both are equally proportional. Also, if you see in terms of US same store sales growth, which is called SSSG, it has been average 4.1% growth, and last 10 years have been really good at 7.4% growth, and which is reflected in Domino's performance, where you get almost a 22% return versus Nasdaq 11% CAGR, which means it has beaten Nasdaq heads down. And the same kind of performance which you see in Jubilant Foodwork, it has given almost a 33% CAGR, and this was when the stock price was around 4K. Now trying to understand Domino's. So Domino's India, which is Jubilant Foodworks, so they don't have only Domino's Pizza, but they have some other brands also. So they operate in Domino's Pizza, they operate Dunkin' Donuts, there's something called Hong's Kitchen, and they have something called Ekdam, which is a biryani brand. And they are the QSR Big Daddy in India. They are also present in Bangladesh and Sri Lanka. And the story in last 3-4 years, the price story looks very rosy, but when you look at the share price, in fact, let me show you the share price. When you look at the history, the 2013 to 17 period was quite a painful period when the stock didn't move anywhere. And then from 17, 18, it has had a big run. So it has gone through its own lean patch, and we will try to understand why. Also, Domino's compared to other players, QSR players, they have a high share of online delivery, which you can see the kind of exponential increase which they had in the number of mobile app downloads for Domino's. So their app growth was, their online delivery was not driven by the Zomatos and Swiggies of the world, but they created their own infrastructure, and they have done humongous growth. Also, initially that 2013 to 17 pain period, they tried to expand into Dunkin' Donuts, but that strategy didn't work, and they had cut down these stores over a period of time, and that has worked in favor. Also, if you look at the store growth, from 465 stores, now Domino's has almost 1373 stores. So they have done quite well in terms of their store growth, and still predominantly it's a pizza company where you derives bulk of revenue from pizza, but they do generate revenue from all the other food products also. And also, if you look at Jubilant, though it started as a pizza player, now they are present in almost all the segments. So Domino's is there for pizza, then they have Dunkin' Donuts. Recently, they got franchisee for Popeyes, and Popeyes is like, it's a competitor for KFC, and Popeyes is growing at a very high rate. I will talk about it in some other video. And then they have their own Chinese brand called Hong's Kitchen, and then they have their own biryani brand called Ekdam Biryani. And these are some of the segments in food which are growing at a very high rate. Also, if you look at the overall profitability growth, gross margin, you can see the company went through a lean patch in this period when the margins didn't, increase. You can see the gross margin has fallen from, EBITDA margin has fallen from 17% to 9. And then this EBITDA margin has improved from 9% to 27. And if you see their delivery, it's not like they waited for COVID to happen. The delivery revenue, the delivery share was always bigger. In fact, even into FY15, they had almost 68% share from delivery. So basically, if you see, they have done a good store expansion. If you see the same store sales growth rate, it was very patchy between FY14 to 17. So one caution, don't take these kind of, SSSG growth as something which is sustainable. This is also cyclic based on consumer sentiments. And there were 4 or 5 years where the consumer sentiments were not positive, and the same store sales growth didn't grow. Same store sales growth is like, on the same store, currently, if I am doing right now 100 rupee turnover, then next year, if I do 110 rupee turnover, that is how it should look. So there are multiple levers for revenue. How much of additional revenue you generate from the same store, how much of new revenue you generate from the new stores, how much additional profitability you generate by improving your margins, whether that is coming from online delivery or whatever. So you can see there are so many levers of growth. And Jubilant, though they struggled for 3-4 years, both in terms of margin and SSSG, but what happened in post 17, the store growth was already there. Then the margin growth happened, and then the same store SSSG growth happened. And that is why you saw a big, rise in the profit, and hence, the valuation and everything. Also, if you compare Domino's with other players, they have done fairly well despite of being a bigger size player. If you see their store sales growth rate, or if you see their, outlet growth, they have grown at a much better rate than players which are smaller in size. So they must be doing something right. Like if you compare Domino's with Westlife, the Westlife has grown at a much lower rate. And Domino's is much more better diversified, whether you look there, north versus south versus east west presence, or if you look in terms of their presence in urban versus tier 1 versus tier 2 cities. So always, it is a much better player. So if I summarize everything again in our webinar, we have tried to, combine all this analysis, but I'm giving you for Domino's. If you see Domino's, they're one of the best performers because the kind of gross margins they maintain, it is highest. And the reason for this high gross margin is, if you look at the average store size of a Domino's store, it is much more smaller compared to, some of the other formats, peers. But because of their high online sales, they deliver relatively higher EBITDA per square foot size on a lower capex per square foot capital expenditure. So their per store capex is somewhere around 2.5 crore, but their EBITDA which they generate is much more higher, and the EBITDA margins is higher, the gross margins are higher. The reason being, I attribute that reason to one, the overall scale, economies of scale, but the second is higher proportion of online delivery, and third, this online delivery is not happening through the third party. They have built their own tech ecosystem, which may be coming from the parent, because you saw the parent also generates same kind of return, same kind of high delivery share in respective countries. So if we look in terms of scale, in terms of growth, in terms of SSG, in terms of store level ROI, return on investment, risk, Domino's is really Jubilant. If I say Jubilant is really, really, really a better player compared to a lot of peers. So the question is then why the price is falling. But before that, let us also look at the future prospect, because when we are looking at the price, we cannot just look at the valuation on a PE basis. We should look at, or some valuation metric, we should also look at how the future lies. So first is, for any company to grow, there should be an industry size opportunity, and then only the company can grow. So when we look at the industry size opportunity, and when you look at the overall food chain market, Domino's, they operate on the QSR segment, which is quick service restaurant. And this quick service restaurant market itself has grown at a 19% CAGR, and this is expected to grow at a 23% CAGR. The reason I see this higher number may be because in COVID, a lot of these were closed. So there will be some kind of, additional demand coming. So it has both size, because QSR is almost 47% of this whole food service chain market. And then they have a high double-digit growth also. And then if we break this market in terms of different kind of food products, pizzas, they have grown at 13%. So you might have felt that, okay, Domino's has grown at 10% store, which is not so high compared to 19% growth. The reason is there are certain other segments which are growing at higher rate. And actually Domino's is getting into some of these segments, but core pizzas have grown at 13%, which again is a decent growth rate. So how Jubilant is looking at a future and future growth. And again, I have one slide from, a slide from Domino's parent, Domino's USA company. And if you look at the Domino's USA investor presentation, look at the kind of importance India is getting. It is at #1 in the emerging market. And last disclosed store count as per them was 1435, and they see a potential of 3000 stores from here, which is almost double. And also there is a lot Domino's is doing in terms of marketing, in terms of promoting their own tech stack, promoting their own app, so that people deliver from Domino's. Because when they deliver through a third party app, of course there is a extra expense and operations. So they try to encourage through various marketing offerings, where they are encouraging more and more people to order through their own app and driving their own deliverables. Also, they have got this exclusive franchisee of Popeyes, and I am giving you numbers of Popeyes, how Popeyes has grown versus KFC. If you see the system-wide sales of KFC versus Popeyes, again I am taking numbers from some of the some of the international numbers from research reports. You can see the kind of growth rate Popeyes is having. So this looks like another interesting addition. And this Popeyes agreement is not only for India, but it is for Bangladesh, Bhutan, Nepal also. Also, Jubilant now, from being a franchisee operator, they are trying to become a brand, and they're trying to identify. So in one of the previous slides, you saw there were some ethnic fruit brand which are growing at 47%. So Biriyani is one of the highest growing segment, and they have come up with their own brand name for Biriyani, and their Ekdam, and they're into Biriyani. The Hong's Kitchen is the plain, in the Chinese segment. So this is the play beyond pizza, and this is through Hong's Kitchen. Also, what they're doing, they're acquiring certain assets. So DP Eurasia is a company which manages Domino's pizza business as a franchise in Netherlands. And some of these companies, they have become balance sheet heavy, and they have lost the track. And actually Domino's is going and acquiring stake in some of these companies. Even in India, they have acquired certain stake in Barbecue Nation. So they're trying to go beyond the typical franchisee operator by creating their own brands, going acquiring peer companies in other countries and all. And they get a lot of importance in terms of how the parent brand owner, they look at the India business. So then comes about valuation, but before valuation, so in valuation, what we have tried to do is, see, when the companies, they do well, everybody talks about 70 PE, 80 PE. The problem is, at the peak of growth, at the peak of margin comes the peak of valuation, because everybody tries to chase the same story. But most of the times life goes with reversion to mean. And I have shown you, it's not like the SSSG growth rate is secular. It's not like margins can keep on improving. Most of the times businesses, they go on cycle, whether it's a consumption business or some other business. It's just that some are highly cyclic and some are lesser cyclic. So it is very important to get a context of how much of future growth is possible, and what kind of growth, what kind of P multiple or valuation multiple it can demand. So the best way to look at where those kind of growth has happened and those markets are matured. Now, what kind of, P multiple those companies get. And what we have done for this is, so we have tried to take some of the, QSR brand owners, franchisee owners. Now, Domino's, because it's a franchisee, but we see some initial signs of they're trying to even create brand. But this is how it looks like. So I have taken some of those franchisee names which are relatively much more stable with a better balance sheet, and we have tried to look at the mean of their last 3-4 years of market capitalization to cash flow from operation, and it looks like they operate somewhere around 17 to 18%. Now, given Domino's still has a scope of growth in India, the market is still under penetrated, and last 10, 12 years, the best possible long-term CAGR between a 4-5 year duration has been 18%. So it looks like 18% is the best growth run rate which can happen over 4-5 period. Based on all of this, we have taken a growth assumption of 14% CAGR for next 10 years. The best PAT margin has been 11%, and we have taken a 10% PAT margin. And given these companies operate at current multiple of 17, 18 times with a mid-single digit growth rate, after 10 years, we are still considering a 30x price to cash flow valuation for Jubilant Foodworks. So if we take all these assumptions against today's current market cap of 33,000 crore, if we take the cash flow number at a 14% revenue growth rate at a 10% margin multiplied by the cash flow from operation multiple, we get 10th year market cap around 70,000 crore, which is a CAGR of 8%, which may not look great, because if some of the things can go wrong, if they cannot achieve this kind of growth, of course, see, these are all assumptions. If they can grow at 20%, this number will surely increase. So these are future numbers. The problem is nobody knows how future will play. So investing is all about investing in uncertainty when your risk reward is in favor, and when your probabilities are in favor. So to me, it looks like maybe slowly the window of opportunity will open, but still maybe instead of this 33K, let's say if this becomes at 26K, then the same thing, the proportion changes. And, this is almost double, but at a 25K, it'll look triple. So 25K to 70K is 3X, whereas 33K to 70K is, 2X. So still, I believe, it's not like a mouth-watering valuation at all. Maybe somebody should start looking at, keep in watch list. But what I want to highlight, few months back, this stock was at a price of 4,500 rupee, and from 4,500 it has come to 2,500 rupee. So imagine the kind of, if you assume nothing changes in last 3 months, assume the same valuation exercise 3 months back, then basically the company was available at 65K, and on these numbers, basically a 10-year exit was 70K. You can say after 10 years, it should get 100 PE. No, I mean, anyway, it can go anywhere. But this is my way of doing it. You can put your own assumption numbers. But I hope now you appreciate why the stock has fallen from 4,500 rupee to 2,500 rupee if you put these numbers. And that was the reason when we looked at this company at 3,200 while studying, we really liked the company, except valuation and some small promoter issues. And let me highlight some of those promoter issues in the one, it's part of Jubilant Bhartiya Group, and if you look at the family, there are two parts. There is a Jubilant Group promoter, and there is his wife Shobna Bhartiya, and there are two kinds of business they run. What I have studied is, one is all this Jubilant business, which is the food work business or life sciences or Ingravia, and then the Bhartiya Group business is more around HT Media and HMVL and all. And on the Jubilant side also, one or two incidents happened earlier when they tried to increase the royalty, and when the market really crashed the stock, then quickly they they changed their decision, which was something which was not nice, which didn't reflect well. If we look at the HMVL history, Hindustan Media Venture, which is one of the media paper company, there was almost 700 crore of cash, and there were almost 2 year of period when everybody was asking what you will do with cash. And somehow I got a feel that it was the whole cash was not used properly from a minority shareholder perspective. So all I am telling is, usually we say, one is, until somebody is proven guilty, we should not declare him say good. But in stock market, I go with reverse philosophy. Until somebody has proven honest, it's better to think him guilty. And these are one or two, three small promoter-driven incidences which always create a little bit of caution in my mind. So from a valuation perspective, I thought I will highlight that factor also. If we look at charts, so this is interesting because when you look at Jubilant charts, the stock was in a very good momentum. And for any kind of momentum investing, I rely a lot on 13-week, 20-week moving averages, and above that, till the stock is above that, I don't worry much. But if you see, the stock created the first big bear pattern here, where this candlestick was almost 2.5 times bigger, and this is where the top was made. And if you see, it tries to go up, and multiple attempts, it could never break this high, and it kept on falling, and now it fell below the 13-week, 20-week moving average. Currently the stock is below its almost 50-week moving average, which you can say a 200-day moving average. So the stock has lost its momentum. So neither there is a momentum in the stock, nor I see a lot of valuation attractiveness in the stock. But I like the company, I like the business, I like what they have done compared to the peers. So all this because of all this, all I'm doing is I'm still keeping it in my watch list. I'm looking at the charts every week for some kind of reversal or some kind of signs of bottoming out. Let us see. Currently, I don't have any view. Fundamentally, I don't see enough margin of safety. Technically, I don't see why I should enter. So I'm just watching, but it's always good to keep well-performing companies on our radar. The last point, the risk. So if we look at the key risks, one, because there are franchisee operators, so there is always a contractual risk, because these franchisee agreements are very nuanced, and 1% change in some of the things here and there could have a major impact. However, I think Jubilant has been one of their best performers, and I don't see any reason why the franchisee owner they will treat them badly, but it remains a risk. The bigger risk are more inflation and real estate prices, and these kind of things do impact the same store sales growth rate. These do impact the overall margins, and you have already looked at the history of 2013 to 17, and that SSSG was not only for Jubilant. You pick any other company also, every company had the same kind of degrowth in same store sales growth, and those cycle can repeat, and then higher rentals of course create pressure on the margins. Third, it's a capital intensive business for the franchisee operator, because owner is working on an asset light model where they provide their brand and they charge a royalty. But the operator, they are the one who has to go and put the infrastructure, create these stores by putting front end capex, and then do the sales. Like they couldn't succeed in the Dunkin' Donut business, and they put everything on the store capex, but they couldn't generate the kind of revenue which should have given them decent return on capital. So it's a capital intensive business with decent ROCE if they are cracking the sales model. But if no, then it could become troublesome, and that is why in many countries the Domino's pizza operators, they are their balance sheet is going haywire, and their valuations have just fallen. And of course, there is increasing competition because you saw the market size opportunity, you saw the growth. So when you have these kind of market size opportunity and growth, everybody wants to come in and grab a pie. And of course, junk food concern, it has always been there and it will remain there. So I don't see it as a major risk, because I think it's very difficult to change human behavior. Like, when people can't stop smoking cigarettes despite of seeing the packet warning. I mean, junk food and all, even if it is deteriorating the health over a period of time, that might be a very slow progress. But yeah, I mean, there are always talk, and because of this, what happens is you get a parallel market created where somebody will come with healthy food and this and that. So of course, more niche brands and more market segments get created, which can take a pie of the existing market. So that is what I had on Jubilant Foodworks video, and I hope you liked the presentation. If you liked it, do like and do subscribe to our channel in case you have not. I will see you in another video. Thank you.